Imagine waking up one morning and discovering that a company worth hundreds of billions of dollars had simply collapsed overnight. Not a small business, not a startup, one of the most powerful investment banks in the world. A company that had survived wars, recessions, and financial panics for over 150 years. That company was Lehman Brothers, and its collapse would trigger the worst financial crisis since the Great Depression. This is the story of how one of Wall Street's giants rose to unimaginable heights, took enormous risks, and eventually brought the global economy to its knees. The humble beginning. The story starts in 1844. A young German immigrant named Henry Lehman arrived in Alabama, United States. Like many immigrants, he came searching for opportunity. He opened a small grocery store. A few years later, his brothers Emmanuel and Mayer joined him. Together they formed a business called Lehman Brothers. At first they sold groceries and everyday goods, but they soon noticed something interesting. Many farmers couldn't always pay with cash. Instead, they paid with cotton. Cotton was one of America's most valuable commodities at the time. The Lehman Brothers realized they could make money by trading cotton rather than simply selling groceries. Slowly, they shifted from retail into commodity trading. What started as a small store evolved into a financial business. This single decision would change their future forever. Becoming a financial giant. As America industrialized, Lehman Brothers expanded. The company moved to New York and entered the world of finance. Over the decades, they helped fund some of America's biggest companies. They participated in financing railroads, airlines, manufacturing companies, and major corporations. As the U.S. economy grew, so did Lehman Brothers. By the late 20th century, the company had become one of Wall Street's most respected institutions. Its reputation was built over generations. Investors trusted them. Corporations trusted them. Governments respected them. For more than a century, Lehman Brothers seemed nearly indestructible. But sometimes, the seeds of destruction are planted during success. The new era of risk. Fast forward to the 1990s and early 2000s. The financial industry was changing rapidly. Banks were becoming more aggressive. Competition was fierce. Everyone wanted bigger profits. And bigger profits usually required bigger risks. Lehman Brothers embraced this mentality. The company expanded heavily into mortgage lending and real estate investments. At first, this looked like a brilliant strategy. The housing market was booming. Home prices were rising every year. People believed housing prices would never fall. Banks were making enormous amounts of money, and Lehman Brothers was right in the middle of it all. The company bought and sold mortgage-backed securities. These were financial products created by bundling thousands of home loans together. Investors around the world purchased them. The profits were incredible. Lehman executives believed they had discovered a machine that could print money. But there was one problem. The machine depended entirely on home prices continuing to rise forever, and nothing rises forever. The housing bubble. To understand what happened next, we need to understand the housing bubble. Banks started giving loans to almost anyone. People with stable jobs received mortgages. People with poor credit received mortgages. People with little income received mortgages. Some borrowers couldn't realistically afford the homes they were buying, yet banks kept approving loans. Why? Because they believed housing prices would continue climbing. If a borrower couldn't pay, the house could simply be sold for a profit. Everyone assumed the market would keep going up. This created a massive bubble, and Lehman Brothers invested heavily in this market. The company borrowed enormous amounts of money to buy mortgage-related assets. This strategy amplified profits during good times, but it would become deadly when conditions changed. Leverage, the hidden danger. One of the biggest reasons for Lehman's collapse was leverage. Leverage means borrowing money to increase investment size. Imagine having $10 and borrowing another $90. Now you control $100 worth of assets. If those assets rise by 10%, you make $10. You just doubled your original money. Sounds great, but what if the assets fall by 10%? Your entire investment disappears. This is exactly what Lehman Brothers was doing. The company borrowed massive amounts of money. For every dollar it owned, it controlled many more dollars of assets. As long as prices rose, profits looked amazing. Investors loved it. Executives received huge bonuses. Shareholders were happy. But leverage is like driving a sports car at 200 miles per hour. It feels exciting until something goes wrong. The cracks begin to appear. Around 2006 and 2007, warning signs started appearing. Housing prices stopped rising. Then they began falling. Suddenly, homeowners struggled to repay loans. Mortgage defaults increased. The value of mortgage-backed securities started collapsing. Investors became nervous. Financial institutions began reporting losses. But many executives still believed the problem was temporary. Lehman Brothers continued holding enormous amounts of risky assets. Instead of reducing exposure, they often doubled down. They hoped the market would recover. It didn't. The situation grew worse. Month after month, losses increased. Confidence started disappearing. And confidence is everything in banking. Panic on Wall Street. By 2008, fear had spread across the financial system. Banks no longer trusted each other. Investors began asking a terrifying question. How much bad debt does Lehman Brothers really have? Nobody knew. The numbers were enormous. Analysts worried that Lehman had billions of dollars in toxic assets. Its stock price started crashing. Investors rushed to sell shares. Credit markets tightened. Funding became harder to obtain. The company's financial health deteriorated rapidly. Executives searched desperately for solutions. They tried raising capital. They tried selling assets. They looked for buyers. But confidence was evaporating. And once confidence disappears, a bank can collapse astonishingly fast. The final weekend, September 2008, one of the most dramatic weekends in financial history. Government officials, bankers, and executives gathered in New York. Emergency meetings took place around the clock. The goal was simple: save Lehman Brothers. Potential buyers were considered. Rescue plans were discussed. Financial leaders understood the stakes. If Lehman failed, the consequences could be enormous. But unlike previous institutions that had received support, no deal could be finalized. No buyer stepped forward under acceptable terms. And the government ultimately chose not to provide a bailout. Time ran out. Lehman Brothers had nowhere left to turn. The collapse. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history at the time. More than 25,000 employees were affected. Hundreds of billions of dollars were tied to the company. The financial world was stunned. People who had considered Lehman untouchable suddenly realized something shocking. Even the biggest institutions could fail. Panic spread rapidly. Stock markets plunged. Investors fled risky assets. Credit markets froze. Businesses struggled to obtain financing. The global financial system entered crisis mode. The global financial crisis. Lehman's collapse wasn't just a company failure. It became a worldwide economic disaster. Banks around the globe suffered losses. Stock markets crashed. Millions of people lost jobs. Countless families lost homes. Retirement savings disappeared. Entire economies entered recession. Governments launched massive rescue programs. Central banks injected trillions of dollars into financial systems. The effects were felt from New York to London, from Tokyo to Mumbai. What started with risky mortgages in America became a global crisis affecting billions of people. What went wrong? So what exactly caused Lehman Brothers to fail? There wasn't just one reason. Several factors combined. First, excessive risk-taking. Second, overconfidence. Third, massive leverage. Fourth, dependence on the housing market. Fifth, poor risk management. And finally, a loss of confidence. When investors stopped believing Lehman was safe, the company couldn't survive. In banking, trust is often more important than money itself. Once trust disappears, collapse can happen incredibly fast. The fall of Lehman Brothers remains one of the most important business lessons in history. It teaches us that success can create dangerous overconfidence. It teaches us that borrowing too much can destroy even giant companies. It teaches us that markets can remain irrational longer than expected. And it reminds us that no institution is truly too big to fail. For more than 150 years, Lehman Brothers survived economic crashes, wars, and financial panics. Yet in the end, a combination of greed, risk, and poor decision-making brought the giant down. Today, Lehman Brothers exists only in history books, but its story continues to serve as a warning for investors, executives, governments, and ordinary people around the world. Because sometimes, the biggest collapses begin with the smallest assumptions, and sometimes, the strongest giants fall the hardest. The rise and fall of Lehman Brothers is not just the story of a company, it's the story of what happens when ambition outruns caution, and it's a lesson the world will never forget.